Internal Revenue Service IRS tax news. A tax checklist for newly married couples. IRS Tax Tip 2020-118, September 14th, 2020. Marriage changes a lot of things, and taxes are on that list. Newlyweds should know how saying "I do" can affect their tax situation. So the IRS is basically saying here, if you're getting married, if you have gotten married, then you might want to take a look at the tax situation related to it. Tax planning is, part of the glorious process of the marriage process as well. There are changes with taxes with regards to going from single filing or head of household to married filing jointly, and with regards to kind of the income flows that could be taking place within a household that of married individuals and possibly dependents at that point. So here's a checklist of items for newly married couples to review. Name and address changes. Name. When a name change through marriage, it is important to report that change to the Social Security Administration, SSA. So obviously we could have a situation where we have the name change with regards to the marriage. You want to make sure that you make that adjustment with the Social Security Administration, and that could then make your tax preparation process easier as well. Noting the IRS basically sees people, of course, as a number, as like a Social Security number, but they want to tie the number out with the name, and you want to make sure they're able to kind of automatically check with their system whether someone has filed twice or something like that. And so you don't want to get things messed up with the IRS's system if they can't properly match up the Social Security number and the name. So the name on a person's tax return must match what is on file at the SSA. Also note, if it doesn't match, if you put a Social Security number that's different than the name that's that's in the system, then you may not even be able to e-file the return at that point in time. Like, you'll try to e-file it, and the IRS might likely say, hey, look, the Social Security number doesn't match, and you could get an error message at that point, which could be frustrating. If it doesn't, it could delay any tax refund. To update information, the taxpayer should file Form SS5, Application for a Social Security Card. It is available on SSA.gov by calling 800-772-1213 or at a local SSA office. There's a link to that SSA.gov location here, so you can check that out. And there'll be a link to this in the description. Address. If a marriage means a change of address, the IRS and U.S. Postal Service need to know. To do that, people should send the IRS Form 8822, change of address. So there's a link to that here. Again, you want to let the IRS know that there's a change of address. Make sure that the mail goes to the right place so you don't get any problems with the IRS. IRS primarily contacts people if there are a problem by mail, so that means you want to make sure you get any correspondence from them so that you can reply to them appropriately. Taxpayers should also notify the Postal Service to forward their mail by going online at USPS.com. There's a link to that here as well, or their local post office. Withholdings. So after getting married, couples should consider changing their withholding. Newly married couples must give their employers a new Form W-4, employees withholding allowance, within 10 days. So the withholdings will be a lot different with married individuals. Now, if you're married, if you went from like a single situation to a married situation, the tax code is trying to be set up so that there's not like a disadvantage to getting married. But in some cases, it actually could work out as a disadvantage if you have things like an earned income credits, or sometimes child tax credits, like the refundable type credits, could be affected when marriage. But generally, the tax brackets are looking to be set up so that marriage is not a detriment from a tax preparation purpose. But it certainly is more complicated due to the fact that married couples now, of course, don't have one single income in the family. Typically, you often have two people that are working. And even if you had just one person working, they may have multiple jobs, especially at this point in time. And you could even have, other people in the family that have income flows of some kind. That really complicates the withholding process, which was the traditional and still is the traditional process of paying the IRS, because when you have all these other things, all these other factors going on, instead of just one wage for the household or the tax return, then you can't estimate the taxes based on that one wage, and therefore you have to basically do pretty much a projection in order to figure out what the proper withholdings would be. And so you're going to need, now there's a tool to do that. You got a tool to do that on the IRS website. You basically need to do a projected tax return really to kind of to figure out the proper withholdings at this point in time, a lot of the time with many households. So back to the text, if both spouses work, they may move into a higher tax bracket or be affected by the additional Medicare tax. So you could have Medicare tax that's going to be affected by that. And just remember that if you were single and you were earning, if you're earning $50,000 a year and you're single, then because there's a progressive tax system. Now the rates are going to be different in terms of how they, when you go into another tax bracket in single versus married. But because there's a progressive tax system, you're going to cap out at whatever the top rate was for the $50,000 as the single individual. Now, if you're married though, and you and your spouse both earn $50,000, you have a progressive tax system. The structure of the tax brackets will be different, hopefully lined up so that there's not a tax disadvantage, to getting married. But still, that means that your top tax bracket is now at the $100,000 level rather than the $50,000 level. So again, that's going to affect when you think about how much withholdings you're going to have on your income. You got to consider what your spouse is doing in terms of their income to see what your actual tax bracket will be, rather than the tax bracket that would have been if that was just the only income flow that was taking place. Okay, they can use the IRS withholding estimator on the IRS.gov website to help complete a new Form W-4. See Publication 505, Tax Withholding and Estimated Tax Tool. Now, this is a pretty nice tool because basically you kind of need to do a projection because once again, you got to do your withholdings throughout the year, or else because you're trying to avoid paying penalties and interest that will be accumulated if you just pay at the end of the year or at tax time. So, there's no way you can know what the actual tax is because it's too complicated, and that's the point. So you're going to have to, all you can do is do a projection, and this withholding estimator tool is getting more and more like, tax software. They can basically help you to just enter a projection into it to see what your projected taxes would be, and then it can help you then to determine how much you should be withholding from the W-2 withholdings in order to meet those tax obligations. Now, there's also kind of some complexity in terms of who should withhold more or this or that because, one spouse might have a higher income than the other, pushing the other into a higher tax bracket, and obviously the splitting up of the work between the two, it needs to take into consideration the splitting up between the primary household items and the work items and whatnot. So the fact that there could be a difference between one person earning more than the other person could mean that there's a difference in the kind of withholdings you want to be taking from one to the other, and kind of working out whatever you think is most appropriate for that. But you got to take both incomes into consideration when thinking about the withholdings as a total overall. So filing status, married people can choose to file their federal income taxes jointly or separately each year. While filing jointly is usually more beneficial, it's best to figure the tax both ways to find out which works best. So when you're married, you no longer have the ability, typically, for the most part, to file single, right? You've lost that. I mean, you're married now. So now your only choices are to file married filing joint, which almost all the time is the way you really want to go. Or you can file married filing separate. Now, married filing separate, you do want to check what state you're in to see what type of state you're in with regards to the joint property states and whatnot. But married filing separate is not the same as filing single. You're not going to have some of the same kind of things you would as if you're filing single, because the IRS doesn't want some things to be taken advantage of. So, for example, if you were single and you were getting a benefit of refundable credits, like an earned income credit past the amount that you would have paid, or even the earned income credit and like a child tax credit, especially the refundable portion of the child tax credit, these are things that if you filed married filing separate, those are some things you may not still have the ability to be picking up. Whereas if you were single, you may have been able to pick them up, right? So there's some things that won't be there because the IRS is afraid of the abuse of switching back and forth between married filing joint and married filing separate. So therefore, usually once married, the married filing joint will work out best, but you can work it out both ways. Married filing separate, married filing joint, and see if some circumstances may be there in which married filing separate would be beneficial. Remember, if a couple is married as of December 31st, the law says they're married for the whole year for tax purposes. So you may want to take that into consideration, for the married, right? I mean, if you're married before the end of the year, that means you're married for the entire year. So basically, if you got married in December 15th, then typically your choices at that point in time for filing would be married filing joint or married filing separate. You typically can't, you don't, even though you were single for the entire year up until December 15th, you may not then be eligible to file for the single. So if it's an advantage to file married, if there's a substantial tax advantage, then maybe you want to, rush out there and get married, before the end of the year to file married filing joint. And if not, if it's a disadvantage for whatever reason, then maybe you want to wait till January. So scams, all taxpayers should be aware of and avoid tax scams. The IRS will never initiate contact using email, phone calls, social media, or text messages. First contact generally comes in mail. So the IRS will generally contact people through the mail is the most part. They're a bureaucratic organization. They work fairly slowly. You don't want to get in trouble with them, but you'll usually know quite well if you're in trouble with the IRS because they will have sent you by mail every 30 days, some kind of correspondence that hasn't been responded to or something like that. So generally, if you get an urgent text message that you got to do this right away or something like that, that's not typically how the IRS will work. So those wondering if they owe money to the IRS can view their tax account. There's a link to that here, information on the IRS.gov to find out. There's also more information and links to that. Topic 157, change of address, how to notify the IRS. There's a link to that here. There'll be a link to this in the description.